Hello and thanks for watching this video. I'm Anthony Cradfield, the Managing Member of Vital Wealth Management. Today is February 24th, 2025. I've put together 11 slides I'd like to share to help explain the current market environment. If you have questions on these slides or would like to set up a meeting to discuss any of these topics in more depth, please call or email me. Today's topics will include stock performance, bond performance, money flowing into stock and money market funds, inflation, as well as real returns, which is just a fancy word for returns after inflation. So goes January, so goes the year. A positive return for stocks in 2025 started with a January return of 2.8% in the S&P 500. So what might the next 11 months look like? Well, positive returns have tended to carry through. So the average return for the remainder of calendar years following positive or negative first month returns, going back to 1926 through January of 2025, we see that calendar years with positive Januaries had an average return of 12.8% over the next 11 months. While if January was negative, there was an average return of 7.6% the next 11 months, with 80% of the time the stock market being higher after a positive January. So that gives us some, optimism going into 2025. One of the biggest risks that stocks might face is the risk of an economic recession. So we look at a recession indicator from Ned Davis Research, NDR. There are currently no signs of a recession in the NDR probability model. At least 5 of 10 indicators must be met in order for there to be a recession, for them to call a recession. And if you look back on this graph since 2000, there have only been 3 recessions in the United States. So in the early 2000s, 2001, 2008, and 2020. So it's not common for a recession to occur to begin with, but it is important to note that there are no signs at this moment of a major slowdown in the US economy. Earnings drive stocks, not Washington. I've gotten several calls and emails over the last 12 months about what's going on in Washington, D.C., whether you like it or don't like it. But my answer has been every time, follow the profits of the stock market and you will follow the returns. And if you look to the right here, you'll see the S&P 500 profit margins, and you can see the gray area shaded is a recession. And you'll see a sharp drop in profits of companies during recessions. And so right now we're at a 13% fourth quarter profit margin for the S&P 500. Things look pretty solid out there at this point. So at this moment, there is no particular concern about a huge drop in earnings growth for the S&P 500. Let's speak a little to stock and bond performances on a year-to-date level, but as well as a 1, 3, and a 5-year rolling period. If we take a look, this is all through February 21st of 2025. The S&P 500 year-to-date has a 2.4% return. International stocks are up 7.84% this year, and the Barclays aggregate bond market is up 1.52%. If we take a look over the last 1 year, the S&P is up 22%, while international stocks are up 10%, and the Barclays aggregate bond market is up 1.3%. Over the last 3 years, the S&P is up 13% per year, international stocks are up 5.7% per year, and the Barclays aggregate bond market is down 2.3% per year for the last 3 years. And then over a 5-year period, the S&P 500 is up 14% per year, international stocks are up 6.6% per year, and the Barclays aggregate bond market is down 0.29% per year for the last 5 years. Seeing that the S&P 500 tends to average 10 to 11% per year long term, it could make sense for the stock market to underperform its last 5-year average, but probably still be positive. International stocks might do a little bit better since they average in the same ballpark as the S&P long term, but have underperformed in the long term. And you can see that the Barclays aggregate bond market has improved year to date and on a 1-year level, but is still trailing its long-term returns of, say, 3 to 5%. With bonds being the worst performer over the last 3 and 5 years, I think it's important to look at bond performance here with positive real yields. Real yields could boost bonds. Real yields are just the return of that investment minus inflation. Right now, inflation's around 3%. So if we take a look at the real yields for 5-year US Treasury bonds, which are loans to the US government for the next 5 years, you can see that in January of 2025, the real return is 1.4% after inflation. That's in line with where things were in February of 2015 with a 1.6% real yield. However, it is important to note that in June of 2022, you can see this graph get down to as much as negative 6%. And that's when inflation was peaking and around 9%. And the Fed hasn't raised rates yet to that degree, and bond yields were still very low. So there was a negative return on bonds. The good news is that that negative real yield is gone. So when you start from a place where bonds actually have a positive real yield, you'll see on the right here that when the real yield is greater than 3%, bonds can perform at 11.3% on average per year the following 12 months. When bond real yields are between 1 and 3%, that annual return looks like 6.3%. And when bond real yields are below 1%, those returns are more like 1.6%. So the good news is, realistically, we could be looking at bond returns of 1.6% to 6.3% over the next 12 months. I'd like to pivot here on this slide and speak more to fund flows. Fund flows is just a fancy word for money that goes into stock funds on a calendar year. What you'll notice on the left slide here is that in yellow, Morningstar has pointed out the 10 best inflow years for stocks. The middle inflow years are in pink, and in reddish orange, you'll see the 10 worst inflow years for stocks. On the right side, you'll see the US stock performance following those fund flows into stock mutual funds as well as ETFs. And this data goes back to January of 1993 through October 31st of 2024. And what you'll notice is that when a lot of money pours into the stock market, like it did in 2021, for example, the next year's return is usually worse than average. So following the 10 best calendar years for stocks, fund flows, you actually saw 1.6% return in stocks. The middle calendar years, which we're in now, would be a 11.3% rate of return on average. And the 10 worst calendar years for stocks actually came with the best future performance of 24%. So this all kind of makes some sense. When everyone piles in to the stock market and puts a lot of money towards it, usually all the good news is priced in and you get below average rates of return, like 1.6, for example. When everyone is down on the stock market, you tend to get better than average returns because there's a lot of bad news priced into the stock market. And currently, we're really in this middle calendar year with 2024 only seeing something like 81 billion through October into fund flows. So the idea here is that realistically, we could kind of be in that kind of middle zone for stock performance. Again, maybe in that 9, 10, 11, 12% rate of return performance. So let's talk a little bit about money market fund flows as well. So money market assets right now are at a historic high. It makes sense. The Fed has raised interest rates to where you can make 3 to 4% now with safety in a money market fund. So that makes a lot of sense for people that might need to use money in the next 6 to 12 months. But if you're a long-term investor, a money market is a very poor long-term investment. And we kind of point that out here. In December of 2024, we actually hit a high of $6.8 trillion in money market funds. Stock performance following previous peaks in money market funds, that chart is on the right. And what you'll notice is that US stocks in yellow outperform the money market rate of return, whether we go back to 2003, 2009, or 2020. The US stock performance over a 3-year period following money market assets hitting a record high tended to do a lot better than the money market itself. So it's just an example of, keep your money market there for when you need it in the short term. It's a great thing to have, but as a long-term investment, you really want to get that moving in stocks or bonds for your long-term financial future and to increase your return after inflation. All this talk about real returns after inflation, I think it's important to just focus on inflation for a second. The headline CPI year over year is 3%. This assumes food and energy costs. January marks the 45th straight month of core CPI above 3%. It's the longest period of elevated inflation in the US since the 1990s. And what you'll notice here is that while January of 2025, we're looking at 3% inflation month or year over year, that is, the 50-year average is 3.7. And you can see this blue line to the right has come down dramatically off the 9% highs of June of 2022. So while inflation is working in the right direction, it is still towards the 50-year high that we're looking at on an annualized basis. So let's look at real returns after inflation of some major asset classes. Ned Davis research put this together for me. And if you go back to 1926 through the end of 2024, you'll see that the S&P 500 had a gain of 7.2% after inflation over that period of time. The Barclays Corporate Bond Total Return Fund had a 2.4% return after inflation. That's if you loaned money to quality corporate bonds in the United States. In Barclays Treasury Bond, if you loaned money to the US government, made something like 2% after inflation over that same period of time. In Treasury bills or money market funds, the total return was 0.4% after inflation. So this is just a reminder of why we invest in stocks. The volatility that comes with that is to get the better returns after inflation. It comes with a little bit more volatility and a little bit more risk, but long term, having that right stock exposure will make sense for your portfolio and your financial future. This is one of my favorite slides to discuss on an annual basis. This is the Ned Davis Research S&P 500 Cycle Composite for 2025. The blue line is what Ned Davis thinks will occur based on history. The orange dotted line is the actual S&P 500 through February 21st and plotting its performance. The Ned Davis Cycle Composite looks at 3 equal weights. It equally weights the 1-year seasonal cycle for the stock market, the 4-year presidential cycle for a stock market, as well as the 10-year decennial cycle. So it's found that this is the closest correlation to future performance. And I always think this is kind of a fun guideline to look at while trying to gauge where the market might go from here. And it does look like, based on history at least, that the first half of a year like this tends to be a better performer than the second half. All that being with the fourth quarter still has a bit of an uptick here. Usually there is a kind of a Santa Claus rally, an end of year rally in stocks, but it does look like they're calling, based on history, the idea that the first half could be the stronger half of 2025. With all the talk of tariffs as well as AI, the optimism of the future technologies, as well as the pessimism of taxes or higher taxes in the form of tariffs, I always find it interesting to go back in history and look at kind of long-term returns for various types of portfolios. Everybody has an asset allocation, and your asset allocation is just your percentage of stock and bond breakdown. What percentage of ownership of companies and stocks do you have? What percentage of bonds or loans do you have in your portfolio? So if we start at the left, you'll see 0% stocks, 100% bonds. The yellow area, shaded area, shows the average return of that investment going back to 1925. So if you don't own stocks and you put all of your money in bonds, you average about 4.8% per year in bonds. If you put 30% in stocks and 70% in bonds, the next graph to the right, you'll see 6.9% is your average return in that portfolio. 7.5% is the average return of a 40% stock, 60% bond portfolio. And if you keep going over, you'll see 60% stocks average 8.6%, 70% stocks 9.1%, and 100% stocks are in that kind of 10 to 11% range. So regardless of some of the new things and the news du jour that is affecting stocks and the marketplace, when you go back through time, over the last 99 years, and you look at these returns, they ring true that stocks will outperform bonds over time with more risk, but having that right mix of stocks and bonds for your risk tolerance to meet your financial plan is what we aim to do here at Vital Wealth Management, to make sure that if you do have concerns, reach out to us so that we can monitor this and make sure that you're on track to meet your long-term plan. And if so, maybe it does make sense to reduce your risk. If not, it still might make sense to take a lot of risk in the markets to ensure that you have a quality future success. Thanks, and have a great day.